Hey guys, it's Brian. Welcome to Financial Fitness. If you're new to the channel, please subscribe. In this video, I'm going to talk about tax tips for both active traders and long-term investors. Even if you're not trading short-term, some of these tips are good to know as any type of investor. Let's get started. You should never make trading or investing decisions based primarily on potential tax consequences. Your trades and investment choices should be driven by your financial goals, financial situation, timeline, risk tolerance, and any other factors specific to your life. This includes your risk and return expectations for each trade. But as part of your overall trading strategy, better tax awareness does have the potential to improve your after-tax returns. With all this in mind, here are 4 tips on taxes to think about when trading. Knowing the different tax rates for short-term and long-term capital gains. When it comes to trading and taxes, timing matters. Trading strategies are often short-term in duration, such as day trading or swing trading. You should be aware of the higher tax rates associated with short-term capital gains versus long-term capital gains. Investments held for more than 12 months before being sold are taxed as long-term gains, with a top federal rate of 20%. Short-term capital gains rates for investments held for 12 months or less before being sold have a top federal tax rate of 37%. For high-income earners, an additional 3.8% net investment income tax may apply in either case. In addition to capital gains on price appreciation, dividends are also taxed if you end up owning a stock when it pays a dividend. Ordinary dividends are taxable as ordinary income, while qualified dividends that meet certain requirements are taxed at lower capital gains rates. For non-traditional investments like cryptocurrency, the tax policy is still subject to a lot of change since it's a fairly new type of alternative investment. In 2014, the IRS issued Notice 2014-21, which states that virtual currencies would be treated as property. This distinction is important because personal property is subject to capital gains tax rates, whereas trading of currency is generally subject to ordinary tax rates. As always, consult your tax advisor, CPA, and accountant if you have specific tax questions regarding your trades and financial situation. Understand your cost basis. If you sell an investment for more than the original purchase price, plus any cost basis adjustments, the difference is taxable as a capital gain. For tax purposes, your cost basis is determined by the price you paid to purchase a stock or other investment, plus any additional adjustments, such as transaction costs like broker's fees or commissions. There are 2 general ways to calculate cost basis: actual cost method and average cost method. This can be a bit confusing and sound very similar depending on what you invest in or your trading volume and the amount of shares you purchase. I review these in my wash sales videos also, so please check those out if you haven't already. The actual cost method is commonly used for stock trades, and as the name suggests, uses the cost of each share purchased to determine your cost basis. This can get complicated fast depending on the volume of shares you purchase for any stock. This is also the default selection for cost basis by many brokers. You need to know which shares are sold and at what price for each. As an example, let's say you bought 1,000 shares of a stock at $10, but when you decided to sell, the shares executed at slightly different prices. 300 shares were sold at $10.26, 350 shares were sold at $10.27, and 350 shares were sold at $10.28. So your cost basis in this example is $10,000. Your total proceeds from the trade is $10,270.50 when you multiply out the bunches sold at different prices and then add them together. This can happen with just about every trade you execute, and I think you can see how bad this could be from both an accounting and tax perspective. If you only trade bigger companies with a lot of shares outstanding versus smaller companies with fewer shares in the market, you may not encounter this, and your shares could execute in 1 block instead of 3, like in my previous example. I do not use this method and selected the next method for myself personally, though I'm not suggesting you change methods. All of this is simply for awareness around your cost basis options and whichever works better for you. It's ultimately your choice. The next method is the average cost method. It takes the total cost or proceeds from the trade and divides it by the number of shares bought or sold. Going back to my example where the sale of the stock executed in 3 bunches, the total proceeds were $10,270.50. Take that same number and divide it by 1,000 shares, and the average cost becomes $10.27. If you use this method, your 1,000 shares were all sold at $10.27 for tax and accounting purposes. I think this method is easier, but work with your accountant to pick the method that works for how you trade. Harvest your losses, but beware of wash sales. I have videos on tax loss harvesting and multiple videos with scenarios and FAQs about wash sales, so please check them out for more details on both topics. Tax loss harvesting allows you to sell investments that are at a loss, replace them with reasonably similar investments, and then offset investment gains that have already been realized with those losses. Essentially, tax loss harvesting allows you to offset your capital gains by strategically selling investments that are at losses if you have any that are below your original purchase price or cost basis. Let's look at a hypothetical example. Suppose you own a consumer staple stock like Kimberly-Clark, whose current price is below your cost basis, and maybe you're not convinced that it will come back over the short term, but you still believe in the long-term prospects for most parts of the consumer staples sector. If you have realized gains in other parts of your portfolio, you might consider selling the stock and replacing it with a consumer staples ETF. You could choose a broad consumer staples sector ETF, or you might consider a more narrowly focused consumer staples industry ETF if you believe in a particular segment of the consumer staples sector, like household products, food products, or personal care products. If your realized losses exceed your realized gains, you can deduct up to $3,000 or $1,500 for married individuals filing separately of your total realized losses from your ordinary income. If you've been trading for a while and your realized gains and your realized losses exceed the limits for the $3,000 or $1,500 ordinary income deductions in a given calendar year, the tax losses can be carried forward to offset future realized investment gains. As an example, let's say you've had realized losses of $10,000 in the calendar year you are preparing your taxes for. You can use up to $3,000 to reduce your income and carry forward the remaining $7,000 in losses to be used for next year's taxes. This can be especially effective if you've had a particularly bad trading year or if the market just doesn't cooperate with any investments like in 2022. Harvesting your losses to offset taxes on profitable trades can be an effective way to cut capital gains taxes as long as you don't encounter unexpected wash sales. The wash sale rule generally states that your tax loss will be disallowed if you buy the same security, a contract or option to buy the security, or a substantially identical security within 30 days of the date you sold the loss-generating investment. If you don't understand how the wash sale rule works, you will not be able to effectively tax loss harvest, and your tax bill could be much higher than expected since you won't be able to use those losses to offset other gains or income. It's best to not learn about wash sales the hard way, as many of my viewers have. Some of my subscribers have found my wash sales videos after looking at their 1099s from their brokerages and then searched to understand how their wash sales happened. Unfortunately, there are really no resolutions for wash sales after the calendar year has ended. At that point, it's best to talk to an accountant to see what can be done going forward. If you're aware of something that can be done after the calendar year has ended, please comment so other viewers can learn from your experiences. Utilize tax-advantaged accounts. Many traders mostly make their trades in individual brokerage accounts that are not tax-advantaged. But trading strategies can be even more effective in tax-advantaged accounts where you do not have to worry about losses and gains in the same way as a normal brokerage account. As an example, if you sell a stock at a loss, you can buy it back before 30 days without a wash sale, since tax-advantaged accounts don't reconcile losses for taxes until you take distributions out of the account. You may still need to consider wash sales across accounts though, if you happen to own the same stock in an individual brokerage account and, let's say, an IRA. If you trade options, you can do a variety of strategies in an IRA, for example, including buy calls and puts, sell covered calls, and more. Capital gains taxes can be deferred in IRAs and some other retirement accounts until distributions are required closer to retirement to help your money grow tax efficiently over time. When you review your portfolio for tax impacts, consider holding investments that generate taxable distributions within a tax-advantaged account rather than a taxable investment account or individual brokerage account. Keep in mind that as much as trading can potentially improve your portfolio performance, excessive trading in a retirement account can negatively impact long-term financial goals. So make sure you have a solid plan that aligns with your overall objectives and risk tolerance. Here are some key takeaways. Think about the impact of you holding investments short-term versus long-term since capital gains are taxed at different rates. Understand your cost basis, the wash sale rule, and consider tax loss harvesting. Consider using tax-advantaged accounts when trading if you can. Thanks so much for watching. I hope you liked this video and found it insightful. Click the like button if you did, and please subscribe if you haven't already. Click the notification bell so you can see when I post videos next. Feel free to leave comments, questions, and any topics you might want to hear about in future videos to get on track to being financially fit. See you in the next video.